54 and then cool off a bit from there?
Yeah, I think 5400, which is very close to the all-time high, and we're almost there. But still, I think there are basically two things to understand. One is what has been happening over the last 6-9 months. Has anything changed just because the index has gone a little up more than what we expected? I didn't think it would really get too far beyond 5200. And second is what happened yesterday, because yesterday's big jump has a lot of people thinking, is this a new rally? Are we going to 5600? Are we going to 6000 in the Nifty? I think not. I still think it's too early to make that judgment. And if you really look at any average portfolio, the weakness in breadth has made sure that nobody's really made money, even though the index has managed to stay at higher levels, because a lot of stocks have declined in the meantime. And what happened yesterday was essentially, I don't think it had much to do with China, though that's what most of the news said. I think it simply had to do with short covering, because ever since the Nifty's crossed the 5,000 mark, we've seen people building shorts into the market, a lot of retail clients also. And I think what you saw yesterday was essentially a short squeeze, because put writing had reached a new all-time high at almost 60,000 crores. Open interest in put is a new record, never seen before. And that just shows the kind of negativity that was there, and that's what was getting squeezed out. But that doesn't really change the broader market behavior, that where the market internals continue to weaken, IVs continue to collapse in rallies, showing that complacency comes right back, with IV dropping to 14-15% in the last few days. So none of that really gives you comfort to be too long in this market. I think the risk really here, and especially looking at global markets, what happened yesterday, you're at the verge of a commodity collapse. You're seeing the dollar take support near the 40-day average once again for the nth time, and each time it's done that, it's rallied to a new high. So I would be scared of a fresh dollar rally starting going to 90s and leading to a collapse in commodities and equity prices around the world. So I think that's a huge risk right now.
Rohit, so then, I mean, from your comments, it sounds like you think that the risk of trade is towards the downside, correcting towards the downside from current levels of Nifty, barring, of course, any spectacularly positive global cues. But where do you suspect we'll settle if we do see slight downside pressure coming in? What are the lower side numbers that you're watching out for?
I think the downside numbers are very, very deep, because you see, in terms of wave structure, the fall that we saw from April to May across markets, we are counting as wave 1 down, which is wave 1 of a larger downward trend. So what we are seeing after that is a retracement. Some markets have retraced 50% like the US, India has retraced almost 80-90%. Some of the other Asian markets like Shanghai, Hang Seng have barely done 23 to 38%, so they are not even moving up. And you have commodities which have retraced around just 50% of the fall, 50 to 60% depending on the commodity. Crude doing more, copper doing much less. And so these are wave 2 retracements. So when wave 3 down starts, you're basically going to break the lows that you have made in May across markets, and that means pretty steep targets on the downside, which would mean talking about the Nifty below 4800, talking about the Dow below 9000, talking about the dollar index closer to 90 to 100, and so on. Commodities looking at copper going below 270. So that's going to be the kind of picture. I think July is likely to be looking, especially at yesterday's market behavior. I think July is going to be a pretty difficult month.
40, would you call 4800 as a steep, very, very steep sort of fall? It's 10% from here. You know, you got to 4800 earlier, 4786 out of the spot was the low, and then we bounced back quickly, 10-12%. So my question to you,
not 48.
Right, go on.
So I think it's going to be below 48, and once you break 48, I think the targets will be like 45 and lower. So really, it's not. I don't think it's stopping there. If it's getting there, it's going much lower.
But you know, that's what a lot of people said. The market was around 48. There was a fair bit of activity in options around 44, 43, 45. But we never went to that. From 48, the market's gone back to 54. So anecdotally, over the last 1.5 years, the market basically has got a situation where the market has gone from, you know, it gives you a 5, 6, 7, 8, 11%, I think was the max fall that you saw in Feb, early on in Feb, and then it rebounds right off. So, you know, if you were to go with anecdotal evidence, not that, you know, what's happened earlier will happen again, but that's when, you know, how do you play the market? Anecdotally, the market is telling you that you should buy the dips and then probably book profits at around 54 probably, who knows?
Which is what some people have been doing essentially, those who have been trading fundamental portfolios like in our fundamental PMS. They've essentially been for months buying close to the 48, 47, 4600 levels and then selling above 5000 and then again buying below and selling above, and they have done this I don't know how many times now. But the point is that if you've been in this range for so long, and if you look on a chart, it's basically a channelized, it's a small little rising channel and the index is moving within that. At some point of time, it's going to break out of this range. The bet is going to be on which side, and the question is when, because it's been months and months of waiting for and predicting that, okay, now it's going to break out and then it doesn't happen on the upside. Then we say break out on the downside and it doesn't happen. And I think the options market has really taken control of things, because the last time you were at the 18,000-19,000 level, the futures open interest was like 70,000-80,000 crores. It went up to a high of 1 lakh crores. And today, the futures open interest is only some 35,000 crores. So the whole market share has shifted from futures to options, and therefore activity or the behavior of the market has now become more and more related to the options writing. So if you have had, every time you have a lot of put writing or a lot of call writing, the market tends to bounce back on short covering from there. But at some point of time, because this is not just a local theme, it's a global theme, there are two broad themes to watch. One is deflation in global markets, and two, the greater risk for India, because India is not in the situation that other world markets were in. It's actually inflation or hyperinflation in India. That's the bigger risk here. So can the index go to 6,000? Sure. Just allow hyperinflation to happen. You'll end up at 6,000 plus. The question is the government and the people of the country going to be happy with hyperinflation? If they say yes, let's do it for the sake of GDP growth, you get 6,000, because markets tend to react positively to inflation. It leads to higher equity and asset prices. But if you say no to inflation, then equity and asset prices do not inflate. So I think the only reason why India versus other world markets has tended to not fall so much or remain more range bound than other markets is essentially because we are accepting a higher rate of inflation for months and months. The CPI has been in double digits for I think almost more than a year now.
Okay, all right, fair enough. Just an interesting bit of data point which our research team has thrown up. Only 7 Nifty stocks are at a new 52-week high as of yesterday's close. So probably, Rohit, your view validated by what you've been saying, probably being validated with this particular data point a little bit more. But we'll talk about that in more issues. Commodities is an interesting aspect that I want to touch base upon.
I think a large part of the run-up was essentially because of commodities. That was probably the last part of the market that had not moved up till yesterday. So I think that probably happened. Is there more upside? I think if you asked me the same question yesterday evening, I would have said, okay, maybe, because it's closed, market's closed about 5,300, a lot of these stocks have moved up. Doesn't look like you can call for immediate downside. But simply overnight, I look at the CRB index, I look at what gold and silver did. I look at where crude is versus where it was maybe a month ago. Crude is like retraced 61% of its fall. Copper prices, the 40-day average is close to around 310. And then you have gold and silver. Gold actually broke out 2 days back above 1250. And if it had sustained above that yesterday, it would be very clear that we are heading to probably 1270 to 1300. But yesterday it's fallen right back below the 1250 mark, which is not really a good sign. It means that that breakout probably failed. And if it does not manage to go back above that in another day or two, then that would mean that you also have top in bullion. So purely looking at the CRB index, which topped as early as January, and it's not been able to go above the January high ever since. My indication is that commodity prices in general would, irrespective of short-term bounces, would continue to head downwards. And therefore, on every rally, I would actually be looking at exiting commodity stocks, that is metals. Every time they rally up, it would be one more opportunity to actually move out of metal stocks.
Have you looked at the Baltic Dry Index? Do you look at that, Rohit? That one looks really scary.
I wasn't, but recently, although I wasn't recently, I saw that for almost 2 weeks it has been falling almost every day, and that surprised me. But in the short term, we've never really found a very close correlation between the Baltic Dry Index and markets. However, in the medium term, it's like a lead indicator. It's a lead indicator that business activity is probably slowing, and it could probably have an effect on the economic numbers going forward, but it probably might not have an immediate impact.